So in our last class, I think we concluded all the theory that we needed to learn under the company income tax for now. If any other thing comes up, I'll let you know. But I think there's no other thing that is coming up for now. So just focus on the calculating aspect. So let's look at past question and let's quickly do stuff. I remember I have told you that I want to share my screen. Company could be taxed in the following ways. The first one I told you about, I said company could be taxed based on their dividend. Company could be taxed based on dividend. Company could be taxed based on turnover. Spoke about that. Company could also be taxed based on minimum tax. We spoke about minimum tax in the last class. And we said on the turnover, on the total profit rather. Now, in my last class with you, I told you we have 3 types of companies. We have the medium size, the small size, and the large organization. 0 to 25 million is what we call the medium sized company if they have a turnover that is 25 million, 0 to 25 million. So we say the company is a medium sized company. And by implication, a medium sized company will not pay tax. For a small sized company rather. For a medium sized company, is a company that its turnover is greater than 25 million, but less than 100 million. Okay? And by implication, this company, their tax liability will be 20%. Now, having said that, for a large size company, is a company that its turnover is 100 million and above. By implication, such a company will pay 30% of their tax liability. Note, I am referring to turnover. How do we determine whether a company is a big company, small company, or medium-sized company? You can only decide or determine that if the company is having a turnover of a particular amount, and the threshold I've given you for a small business, the turnover is 0 to 25 million, and by implication, such a company will be subjected to company income tax at 0%. That means they will not pay tax liability, right? Now, the next one is if a company is a medium-sized company. For a medium-sized company, the medium-sized company will not pay tax liability, and if they are going to pay any tax liability, such tax liability they will pay will not be more than 20% of their profit, of their total profit. 20% of their total profit. The next one is where a company is a large company. For a large company, the large size company, turnover is going to be 100 million and above, and they will pay tax liability of 20%, 30% of their total profits. Okay, sorry about that. So that is that. So, and you remember when we were talking about tax on total profit, I referred you guys back to your adjusted profit, where we said after we've gotten our adjusted profit for company, adjusted profit is the same as accessible profit. In the world, if there's any balancing charge, we've talked about balancing charge in this class. It is not loading or visible. Is that true? Are you seeing my screen? If you are not seeing my screen, let me know.
I
Are you
can
guys
hear
seeing
you, sir.
Yeah, we
can you
can,
see my
sir.
screen?
We
Someone
can see
said
your screen, sir.
someone said you can't see my screen. The next one is loss relief. You remember I told you that loss has priority over capital allowance. So I'll first take out my loss brought forward. Loss for the year, loss relief for the year, and loss carry forward. So we move on to capital allowance. We have brought forward. Okay, you can now see, thank you. Brought forward for the year. If there's any annual allowance, we bring it in for the year. Relief for the year and carry forward. You remember I told you if the company is a manufacturing company, capital allowance is not going to be restricted. But if the company is a trading company, you will restrict the capital allowance to 66 to 12% of the accessible profits. We spoke about that in the last class. So on this profit, depending on the turnover of the company, if the turnover is not up to 100 million, but it's more than 25 million, is a small size company, then you calculate your total you calculate your company income tax at rate of 20% of total profits for medium size company. Again, if the company is a large company, you calculate it on the rate of 30% of the total profit, and these are total profits. So depending on the size of the company, okay. Now we need to also calculate what we call tertiary education tax at 3% of accessible profit. Remember, I told you accessible profit is the same thing as adjusted profit. So that is that. Once you are able to know this, then you would not have any issue. So I'll take you back to 2024, May 2024, and let's see how to compute the tax liability. If you are with me, I'm with you. Quickly download May 2024, and let's put question number 1. If you are there, I am there.
Sir, did you say May 2024?
Yes. I'm waiting. Let me know your
Yes, sir. Wait,
Okay. Question number one.
Um, Soft Farm and Agro Allied Limited, a subsidiary of Emperor Agro Incorporated, Italy.
So, what do you
Italy
notice from
was
the first, from the introduction of this question? What did you notice?
Please, page what?
49.
What did you notice?
Uh,
Okay.
Agro-allied
that,
company.
is, that is a compulsory
Agro-allied,
course.
agro-allied company, right? So, if the company is an agro-allied company, what does that mean?
An agricultural company.
Thank you. So, by implication, on capital allowance, what is the implication of that on your capital allowance?
There will be no
100%.
restriction allowance.
There will not be what?
No restriction.
Restriction. There won't be restriction on the capital allowance. I am seeing some new faces in my class. Portable, identify yourself. Unjoku Samuel, identify yourself. Eden, identify yourself. Benita, identify yourself. They are not my regular students. Portable, who are you?
Yeah, Surulere friend. Good evening, sir.
You're your own. Okay. Is this class a mesh class? Or you just decided to join?
I just started to join.
Okay, no problem. All right, let's go ahead. Okay, so as I was saying, so it's an agro-allied company, and the fact that it's an agro-allied company, that means that we're not going to what? Restrict the capital allowance. Okay? So the capital allowance will not be restricted. That is number one thing that you note in the question. Capital allowance for this question will not be restricted. Why? Because the company is an agricultural business. Okay? So the capital allowance will not be restricted. Therefore, we calculate 100%. Okay? The next one. Continue.
Okay. It said
Continue.
it was incorporated in January 2018. Soft Farm and Agro Allied Limited produces palm kernel for domestic use and exports to the European market. The MD of the company has just received a letter from the head office parent company of an impending visit occasioned by poor business performance. Below the group's return on investment benchmark of 35%. Since commencement of business, in spite of financial and technical support rendered by parent company, it would be recalled that in January 2022, the parent company granted the loan request of 100 million naira to Soft Farm and Agro Allied Limited for business expansion. The board has scheduled a special meeting for next month for the consideration of the financial reports of Soft Farm and Agroallied Limited
So
for
before
the
you go
year.
ahead, when you look at that, it will be recalled that in January 2022, parent company granted a loan request of 100 million to Source Farm and Agricultural Limited business expansion. Right? Now, you remember in my last class with you, we discussed something on interest deductibility. Do you remember?
Yes, sir.
Interest deductibility. What did I tell you about this? Who can remember?
The interest should not be more than the interest paid to paid out should not be more than a certain percentage of the company's gross. Is it revenue? I think it should not be more than 30%. More than 10%. Sorry. I'm not sure. Okay. I remember. It should not be more than 30% of EBITDA.
So if it is more, what did I tell you?
That the excess will be non-allowable.
Excess interest will be non-allowable, right? Okay, that excess interest, how many years can we carry forward?
5 years.
Good. The excess interest not allowed shall be carried forward for a maximum period of how many years? 5 years. Okay. In this class last week, we discussed tin capitalization. What is tin capitalization?
It's like gearing.
It's like Jerry. We said this will occur where the company is mainly financed by what? By loan. Are we? Okay. And we all know that interest on loan is a liability deduction, right? Because interest on loan is a liability deduction, most of the company, what they do is to obtain loan in such a way that they will not pay tax on that interest on loan. Okay. And what they also do is to do what we call base erosion and profit shifting. You shift the tax liability, the profit from Nigeria, you shift it to another country to the extent that the type of the tax liability on that income, interest on loan, which is an expense to you here, will be income to the other country, right? Other company or other country that is receiving it. In that jurisdiction where the tax rate is low, you can take advantage of that, and you collect, because a group of company. In that group of company, you obtain the loan, and when you obtain the loan, you are trying to now shift the tax, the profit that Nigeria is supposed to make. You are shifting into another jurisdiction. At the end of the day, you are paying lower tax. So you're looking for what we call tax haven. So this interest deductibility rule is just trying to curb any form of tax haven, any form of profit shifting, so that you not continue to shift your profit from Nigeria to another jurisdiction. Okay. Now, having said this, so in this question, when you look at it very well, this company has gone ahead to obtain loan from the parent company that is within the group of company. So that means in your mind, as you are reading it, interest deductibility rule will be going through your mind as you are reading the question. Okay, so we now say the board has scheduled a special meeting. Now, one thing that you also need to know about question number 1 on the examination condition is that the examiner will continue to distract you with unnecessary details. Look at this. The board has scheduled a special meeting for next month for consideration of financials of the financial reports of Sub Farm and Agricultural Limited for the year ended 31st December 2022, and review of past financial reports and tax assessments. All those are stories. Examiner will do that to distract you. As the newly engaged tax consultant of the company, now, requirement usually comes in 2 directions. Requirements usually comes in 2 directions. The first one, requirements could come within the introduction or paragraphs introducing the question. Number 2, requirements could come at the end of the question. So as you are reading along, you must be taking notes of all the requirements. You don't just dabble into a question without looking at the question very well. As you are reading it, step by step, you are looking at the requirements. You are looking at what the examiner might possibly ask you. Now, in this question, as I said, as a new tax consultant, as a newly engaged tax consultant, that means they want to ask you to do something. You have been invited to be part of the management meeting, to the part of the meeting for the purpose of providing professional opinion on tax-related issues that may arise. To help you prepare adequately for the meeting, the financial accountant has directed by the managing director to make available the financial statements for all the periods under review, books of accounts, return file with the tax authority, and other supporting documents. All those information are not important. They are just telling you what they have done. Now said, you noted from the preliminary review of the financial reports for the year ended 31st December 2002, an item that requires further discussion with the management of the company. The issue is in respect of interest paid on loan obtained from the parent company. Interest paid from loan obtained from the parent company. Your mind goes back Okay, you will see it. Who else is not seeing my white marker board? Can you see my board? Please respond.
Yes.
Okay, good. Mr. Jose, you will see it. Now, your mind will go back. Again, the examiner is talking about interest.
Yes, sir. We can see.
Good, thank you. Now, you remember we had indirectly talked about interest deductibility rule here when we saw that they went to obtain loan from the parent company. Now, this tax consultant is also concerned about the interest paid from the loan obtained from the what? On loan obtained, interest paid from loan obtained on loan obtained from the parent company. So they are concerned. Now that means Schedule 7 of CETA should be running through your mind as we are reading the question. Now, they now give us financial statements. Answer for the financial statements for the year ended 1st December 2022 review the following. We are given. Now, under examination condition, you need to look at the question one after the other. The first one, you will start from additional information by analyzing the information requests or given. They said export sales. What happened? They said 20% of this was made available. 20% of the export sales was made to the parent company. If examiner did not put at prevailing price, then Mr. Idris' work on transfer pricing will come in. Because it's a group of companies. If they are transferring between themselves, we must ensure that they are not transferring below the market price and they are not transferring, they must transfer at arm's length. If they are not transferring at arm's length, then transfer pricing will come in. Okay? And that means there's every possibility that we need to disallow or we treat it as non-taxable income. For the purpose of this, we need to disallow that sales. That sales is not, we now go back to take the entire portion and we will not recognize it as part of our sales because of that. Now, because the examiner has said at prevailing international market price, that is, there is no transfer pricing. Number two, the goods is at arm's length. You remember when you talk about arm's length, is that how to write arm's length? Arms. You know how to spell it now. Now, what does that mean? That means a knowledgeable buyer and a knowledgeable willing buyer and a knowledgeable willing seller, that is the price at which the knowledgeable willing buyer and the knowledgeable willing seller exchange goods. At that point, none of them has influence over the other. Because none of them has influence over the other, then we can now say that price at which they have sold it, it has bargaining. Since it is at bargaining, then the price will be considered okay for the tax purpose. In this regard, the export sales of 20% is taxable income. Okay, it is taxable because that's what? It is at open market price. Number 2. They said other income include the following. Under that, you have dividend received. Whether dividend is received net or gross, it is not taxable, not taxable. Okay, so whether it is received gross or net, it is not taxable. Therefore, what do? You disallow that. You will not tax it. Profit from disposal. Is it a taxable income or not taxable income?
Non-taxable.
So it is not going to be taxable, not taxable. Right? So that is that. So these two income are not taxable. Okay, we'll move on to the next one. You can see the way we're analyzing it. Before you start solving, first go and analyze. They said repairs and maintenance. What happened? They said repairs to plantation. Allowable or not allowable? Allowable or not allowable? Talk now.
Repairs to plantain equipment is allowable.
Allowable. That's how you'll be answering it though. Repairs to premises. Allowable or not allowable?
Allowable.
The next one. Expansion to warehouse.
Not
Not
allowable.
allowable.
Why?
Capitalized.
Capitalized. We're so sure of back. Not allowable. Go and watch my video on concept of adjusted profits. We have done this.
I've watched it.
And you understood it clearly.
Yes.
Good.
Thank you, sir.
You're welcome. The next one. The next one is rent paid. They said this is in respect of accommodation for newly employed general manager whose basic salary is 4.8 million. My dear, we are less concerned about that. Rent paid in respect of accommodation for newly employed manager is an allowable expenses to the company. However, this to the individual employee will be treated as benefit in kind. So this is going to be taxable in the hand of the employee. This is going to be allowable to the company. So the employee shall be aware of benefit in kind, while the company shall be what? Allowed to take that expenses. We'll move on. The next one is legal costs. You can see the way we are dealing with it one after the other. That is how you will deal with it in the exam. Legal costs. Costs of income tax appeal. Allow or not allow? Allow or not allow?
Not allowed.
Not allowed.
Allowed.
Not
Represent to appeal.
I have told you, whether it is successful or unsuccessful, it is not allowed. Next, costs of debt collection.
Allowed.
Next, costs of acquiring new lease. Allow or not allow? I'll take you back again. Lease is divided into two.
Long and short.
Long, short. Acquisition of both long and short is not allowable. Renewal of short term renewal is allowable. Okay. Renewal of long term not allowable. Do you understand?
Yes. So disallowed.
So that means cost of acquisition of acquiring new lease, legal cost we pay on it, is going to be disallowed. The next one.
Yes.
The next one. Renewal of old lease. We are contending that there is nothing like old lease. Okay? There is nothing like old lease. Okay? So anybody that are treated this as short-term lease or long-term lease will be anyway that's treated it as short-term lease by allowing it.
Hello, sir.
Go ahead. Go ahead. Okay. So anybody that has treated it as short-term and allow it will be correct.
Yes,
Anybody
sir.
that's
Because
treated
they
it,
say old. Hello, sir.
go ahead. Go ahead.
Because they
I think that's what
say
it is.
old. Can we look at it like long-term lease? For them to
So
say
if
old.
okay, so the way there is also like old, is either it is short-term or long-term lease. Okay? It is either short or long. But in this regard now, the examiner did not say anything. So some students would have treated it as long-term lease and disallow it. Why some would have stated as short-term lease and allow it. Okay, so both application will be correct. Okay, under examination condition. So, which one do we want to take? Should we take short-term or long-term? I do not have an answer to that. We can take any one of it. The next one. The examiner also gave us allowance of bad and doubtful debts. Allowance for doubtful debts.
Sorry, what did you say renewal of old lease is?
Renewal is disallowed.
Okay.
Okay, so allowance for doubtful debts. For doubtful debts, we have said you can make allowance, but with the allowance you are making, is it specific or general? Specific is allowed, while general is not allowed. Why is specific allowed? KYC. I can trace my customer. I know them. They are traceable. Then if I make provision for them, it should be allowed. Customer that I cannot trace, that has no source, I cannot make provision for them. So if you make provision for that, it will not be allowable. Okay? So therefore, for us to treat this, we just go straight to whether it is specific provision or general provision. Any other information on that table will be allowed. And in this regard, the only one that will be disallowed there is general provision is allowed. It should be disallowed. The general provision will be disallowed. So that is that. We move on to the next one. The next one is donations. I told you, we have two types of donation. The first donation is the one that was first recognized by the Act before COVID. Now, under this donation, we said donation is restricted to 10% of total profits. This is Schedule 5 of CETA. Okay. Now, Section 28 is also Section 28, I think. Now, subsection 2 thereabouts, which was introduced by Finance Act 2020, states specifically that when a company makes donation to a fund established by government, such a company has rights to recover back 10% of the accessible profits. So they can recover back 10% of the accessible profits. Okay? So that was what they asked us. So your donation can be in kind, that is, by manufacturing or purchase of equipment. It could also be in cash, but this must be paid to the designated fund established by government for that purpose. Now, I will say that it is very important to note that this type of donation has a maximum period of 2 years. We must relieve it after 2 years, within 2 years, after which it becomes loss. To come back here, this is the first donation that we know that donation is restricted in terms of the total profit. A company cannot make donation when they make loss. A company donation cannot be made out of loss. Donation cannot be of capital in nature. If the donation is to tertiary education or research and development institute, the donation can be of capital in nature. Number next is that donation is subject to 10% of total profit. However, if the donation is made to tertiary institution or research and development institution, the donation shall be lower of 15% of total profits and 25% of tax payable. So these are the types of donations that we have. Now, when you look at what is happening here, the donations that these people made, it is not for exigency. If you look at that, they said donation, Palm Oil Research Institute, National Library, Coca-Cola, Cocoa Research Institute of Nigeria, and Women Society of Host Community. Now, the only one that will be disallowed there is Women Society of Host Community. Now, under this first one, we have some bodies for which, if you make donations, the donations will be allowed. Now, if the body is public in nature, where you see national, Nigeria, all those things are allowed. Where you see welfare, ecclesiastical. Can you spell ecclesiastical? I don't know. That is religious organization. And the last one there is research and development institution. Okay, so those companies will be allowed for the purpose of tax. Now, in this regard, there are several of these, but as you see them, you will know that this is supposed to be allowed. Now, why did we disallow Women Society of Host Community? that is not according to company income tax. So that's why we are disallowing it. It's not allowed. But every other one, National Library, Cocoa Research Institutes, Palmer Research Institutes, they are liable for the purpose of tax. So that's that. We'll move on to the next one. The examiner says interest and other finance costs paid. Now, what is the implication of this? In January 2022, the company obtained a loan facility of 100 million from the parent company. We already told. For the purpose of expansion at a competitive rate of what? 12% per annum. At the competitive rate of 12% per annum. Now, the examiner now further went further by saying the company will have to pay interest due for the first 3 years, while the year 4 to 10, both principal and interest due are to be paid at the end of each year. Okay? So all those drama, we are not concerned about it. The amount this guy received was 100 million, right? So what is the interest due on this? Interest rates. Principal. Principal. Bam, boom, bam, bam, bam. Principal is 100 million. Interest rates is 12%. How much is our interest? Interest is 12 million. Now, the 12 million, when you look at interest and other finance costs paid, you have 15 million, 15 million 500, 15 million 600. So out of the 15 million 600, the balance will be finance charges, Abi, which is 3 million 600. Total 15 million 600, isn't it? Abi, this is 15 million 600. Now, this interest that this guy is due to pay this year, if we check, is it more than 30% of our interest before any before interest tax, and amortization? So I need to go and check. What is my earnings before tax, depreciation, interest, and amortization? Let's go. Now, what do we do? To get our earnings before interest, tax, depreciation, and amortization, now, under the Schedule 9, Schedule 7 of CETA, when the Act divide interests, the Act divide interest to include borrowing costs, to include other financial charges. Okay? And that is why when we are taking out now, we are taking out the total finance charge. But before we do that, we need to know our net profit. How much is our net profit? Our net profit in this question is 105, I mean 104,500. Now we are looking for our earnings before interest, tax, depreciation, and amortization. Right?
Net profit is 560. Hello, sir. It's 560, not 500.
I'm testing you.
Take it off.
I am
Thank you.
testing. Okay.
Take it
So
off.
what do? We will add back because we want to get earnings before depreciation, interest, tax, and amortization. Add them back. What do you have? How much are depreciation? Abi? How much as our interest? How much is our income tax? What do you have? Mr. Idris, are you going to be available tomorrow to teach these people? Mr. Idris. Mr. Idris. If you are talking, your mouth is muted. Your mic is muted. Okay. So what do you have when we added it together? Are we in this class? Can anybody hear me?
Yes, sir.
What is my total?
The total is 77,240.
77,240.
7,240. Okay. What do you have?
1,800.
181,800. Okay. So on that, I want to see maximum interest allowable will be 30% of earnings before interest, tax, depreciation, and amortization. So what is that? 30% of that, what do you have?
54,540.
Interest computed. And we said the interest shall not be more than 30% of earnings before interest and tax. Now that is no more, what do? We allow everything. The interest of 12 million shall not be restricted. Are we? Because it is not up to the 30% of earning before interest, stabilization, and amortization. Okay, so that is that. We are not done. So it's just to analyze that down. Okay, so we move on to the next one. The next one is general expenses. Wedding gifts to staff. Is it allowed or not allowed? Wedding gift to staff, is it allowed or not allowed? What impact does that have on our profit generation? No impact. The next one. Fine imposed on company's driver. Allow or not allow? Fine.
Not allowed.
Not allowed.
Next. Usage expenses. Allow or not allowed? Usage expenses. Allowed or not allowed?
Allowed.
Allowed. Why is it allowed?
It's an expenses on transportation.
Good. Transport and traveling. Allow or not allow?
Allowed.
Allowed. Okay, that's done. Now, the next. This examiner tested the whole section of Finance Act. Let's go. The next one. They gave us schedule of turnover for prior period. And they also gave us the assessments, accessible profits. Let's go. Turnover and accessible profits. Now, our turnover was 154 million. 154,400. Which type of company is this? At that year, what kind of company is this company? Talk, what kind of company?
So is it in million or in thousand, sir?
In thousand. What type of company is this?
Okay, for
Large
2018,
company.
that's a large company.
It's a large company. Though the examiner deliberately kept quiet on this because as of 2018, Finance Act has not kicked in. Okay? So the same thing for, but in 2019, it has kicked in. 198,600. Large or small? Large. Right? The next one, 2020. Large or small? Large. Turnover. $221. Large or small? This is a large company. Now you remember, I told you, you do not use accessible profit to determine whether a company is large or small. What do you use? You use your turnover. Okay? So that is that. The next one, the examiner also gave us schedule of QC They give us schedule of QC. Date of acquisition, type of asset acquired, and the amount of acquisition, right? So that is that. So they now said, as a tax consultant to the company, you are required to draft a report to the managing director of Soft Farm and Aguada Limited, in line with the provision of company income tax that was amended. The report should provide professional advice on one, treatment of excess amount of deductible interest paid. You can see the example. Number two, adjusted profit of the company for the year ended 31st December 2022. Who is that now? Oluwadifemi, mute your mic. So they said you should compute adjusted profit for the company, at the same time tax liability for all the years. Okay. Now, what are the relevant years in this question? The relevant year would have been 2019 to 2022. How did I know? My assessable profit, in fact, 2023. The financial report that we are given is as at 2023, right? But we're given turnover from 2018 to 2021. And if we do our preceding year basis, those would have been in 2019 to 2022. And I know that I'm going further than 2022 because I have financial statements for 2022. Look at this examiner. This examiner also puts marks. Treatment of excess loss. If you don't know that one, you don't miss this mark. What are they asking for? Just for you to speak English around this. Just for you to speak English around this. And you tell them that what I've written here, since the interest is less than 30% of earnings before interest and tax and depreciation, then the interest, the total interest will be allowable. There won't be any restriction. That is what the examiner wants to hear. Okay? And you have to also tell them the number of years you will move it forward. If the company is unable to achieve, if the company is unable to, assuming the profit that you computed was 72 million, then you have to restrict it. But now that it's not that, you won't restrict it. And the balance that you restricted, what you say you will do, you will carry forward. So that is that. So this night, we are going to do one thing and we end the class. And what is that thing that we are doing? We are going to do the adjusted profits. So when we come again in the next class, we are going to be looking at, we have done requirement number 1, that is treatment of excess loss. We have done that. And requirement number 2 now is what we want to do, adjusted profit. So what is the name of this company? Soft Farm Limited. Computation of adjusted profits for 2023 year of assessment. Where do you start from? We start from our net profit, right? How much is our net profit? $104,560. We are adding and we are deducting. Let's go. Number one, we have talked about the repairs. Abi, under repairs, sorry, my whiteboard just disappeared. So under repairs, we have expansion. Now this expansion to warehouse, because it's capitalized, we are also going to calculate depreciation capital allowance on it. 37. The next one. Let's start from the beginning. Dividend. Net. What are we doing to that? Are we adding or we are subtracting? We are subtracting. Profits on disposal. Adding or subtracting? Subtracting. Next, we have treated repairs. The next one, rent paid, that is allowable. The next one is legal costs. Under the legal costs, we said tax appeal is not allowed. Add or subtract, we're adding back. Cost of acquisition, lease. How much is that? 17. What is our decision? Are we treating this renewal of old lease as long-term lease or short-term lease? What is our decision?
Long-term lease.
So if you treat it as long-term, that means it's not allowed. Abi, we will disallow it. Renewal of old lease. How much? 1,150. The next one, bad debts. General provision. How much is general provisions? 7,870. The next one, donation. Women Society of Host Community. How much? 1,000. General expenses. Under that, we have wedding gifts. $350. Fine. How much? 150. Go to the next one. I think that is all. We'll now go back to the body of the question. We now start looking at the question one after the other. Staff salary allow, grant rent allow, motor running allow, audits allow, repairs allowed, depreciation. Is depreciation allowed? Depreciation is not allowed reduction. We have 38, 240. Rent paid allowed, power allowed, legal cost allowed. We have treated that. Income tax. Income tax provision. 23,400. And that is all. No other expenses. Therefore, and we have also treated the income side. So what do we have? So what you are doing is that you are adding everything together. Minus will be minus, plus will be plus. So give me my value. So my accessible profit. That's what we'll stop today. Give my value. 37 plus 37 minus 27 minus 600 plus 850 plus 1,007 plus 1,150 and so like that. Give my value. What do you have? I'm waiting for the value. Give my value. Mr. Idris will teach you guys tomorrow. Mr. Idris will teach. What do you have?
75 for
75.
75 for 460.
Are you sure?
Yes, sir, that's what I got. Let me do it again. That's what I got.
75.
71 for
460.
You got what?
71 for 410.
So I got 75, 110, and I'm sure because I did it twice.
Yes, me too. I got
75,
5, 110.
110. Have you?
Yes.
Oh yeah, add it to that. Add it to 104, 560.
179,670.
Okay. The reason our answer is not the same with the pack is because of this guy that we have disallowed. Okay, in the pack it was allowed. Okay, so that is the reason for our discrepancy. So if you add that back, if you subtract that, you will have what they have in the pack. Okay, so we will stop at this today. When we come in our next class, we'll continue with this question by doing the capital allowance. Okay.
So,
For
sorry,
this
sir.
question.
Sorry, sir. I have
Yes.
a quick question. Yes.
Yeah.
Okay, so I noticed that some certain scenarios in terms of administrative expenses that is related to directors are considered differently. I don't know if we have situation whereby directors' expenses are captured in administrative expenses. Is it
It's
allowable?
allowed. It's allowed.
Is there a threshold to what is allowable?
There's no threshold.
Okay, because oftentimes when directors are not treated as employees, I don't know, is there a certain reason why the situation is like that? Or probably because oftentimes FRS flags some certain expenses in relations to directors' expenses.
Give me an example.
Okay, so for example, now if directors are are not earning salary, but they are getting certain allowances. So what it means is that the director is either seen as, is he executive director or non-executive director here in this situation. But I think certain threshold came up within my office that we had to create certain expenses within a threshold limit for the directors, because the director was not taking salary. So they were asking questions that relating to flight tickets, traveling allowances, and movement around at a particular value. So I don't know if that is allowable or
There is
non-allowable in
no
terms of.
threshold. There is no
Yeah.
threshold. But you remember that at the beginning of this class, one thing I told you is that for expenses to be allowable, 4 things must be known. Such an expenses must be wholly, must be exclusive, must be reasonable, and must be necessary. Reasonability is what the FRS is taking you guys upon. Do you understand?
Okay.
So,
Okay.
but there's no threshold.
Okay.
There's no threshold.
All right. Thank you, sir.
All right. Any other question? Okay, in the absence of no question, Mr. Idris will be teaching you guys tomorrow. Okay, Mr. Idris will be teaching you tomorrow. Note
Okay.
that.
All right.
So you will take your class tomorrow. And there will be
Thank
class
you,
on
sir.
Please,
Saturday.
can I ask you a question? Yes, I understand maybe under the rules guiding company income tax, wedding gift is not allowed, but it still doesn't really make sense to me, because if you can give a staff an accommodation based on other long-term benefits, or maybe based on the person's rank in the office, why can't you give a staff?
Accommodation is part of the what we call benefits in kind, right? So if you have that benefit in kind, then such will be a reliable expense. Company takes that, okay, and in the hand of the taxpayer, it becomes taxable. Do you understand? That accommodation that we are giving you, we will tax it in your hand as benefit in kind. But that gift that we are giving you, are we going to tax it? Answer me.
No, sir.
You now have your answer. Another question. Okay, in the absence of no question, same time tomorrow, Mr. Idris will teach you guys. So, I will have my next class with you will be the end of this topic. My next class with you will be the end of this topic, so that in the month of October we can move on to the hydrocarbon tax. Good day to you.